Good afternoon, everybody. Welcome back to the Opportunistic Trader. It is just afternoon on December 11th, and we're joined now by Adam Collins of Movement Capital. Adam's been joining us regularly to discuss the latest CoT report, market seasonality, and interesting opportunities. How's it going this afternoon, Adam?
It's going pretty good. Let's get right into it. So right off the bat, none of this is investment advice, so don't treat it as such. But turning to the CoT report. All right, so for any new listeners, CoT report basically outlines how people are positioned in the futures markets. So you got different categories like, producers and users, money managers. And then you got how they're positioned, long, short, etc. So for example, for money managers right here, you can net together the longs and shorts and sort of get their net position, their net stance in the market. But it's important to know how that has changed over the past relative to just like one data point. And the main way I look at it is just like a 5-year percentile. So 100% equals they are, very optimistic relative to the past 5 years, 0% the opposite. And this main page on my website sort of shows the positioning by category. So for example, up top, we got spec positioning in commodities, then spec positioning in financials, and then the flip side, hedgers and dealers. So let's see where people are really long, really short. Honestly, not much change from last week in that, traders are still very long nat gas. And there aren't really any extreme crowded spec shorts. You've got feeder cattle and OJ, but those are, sort of less thinly traded contracts. When it comes to silver and gold, it's sort of interesting. Like you can see gold has moved up to right here, which means that, traders have grown more bullish on gold over the past week or so. So not substantially so, but it was a pretty material move. That's sort of, positioning in commodity futures. Palladium's gotten even, more net long. And so it's sort of the one precious metal that stands out of where traders are quite bullish on it. Then we can look at same category, speculators, but in financial futures. So the reason why they're separate, by the way, is because the CFTC, they sort of break out the positioning into different reports. So anyways, we can see the crowded spec long financials over here, which is mainly long dollar. And then also long 10-year has gotten pretty crowded up there. That's sort of new. And it's obviously a big function of like recent price action. And then 5 years right behind it, ultra bonds behind that. VIX too, I'll talk about that in a second. Traders are net long VIX, and positioning it's not extremely long, but it's definitely rare in that there's a bunch of spec long exposure in VIX futures right now. On the flip side of it, just as, you have a lot of traders who are long the US dollar index, you're gonna have a lot of traders, short the individual foreign currencies, like the yen against the dollar, the franc against the dollar, New Zealand Kiwi against the dollar, Canadian dollar against the dollar. Basically, all these contracts over here are foreign currencies against the USD, with the exception of the NASDAQ. Spec positioning remains extremely low in NASDAQ futures, which is, confused me for months. It's just a weird little data point. I wouldn't assign too much weight to it though, because when you look at sort of the equity futures, even the S&P, NASDAQ, and Dow, far more money is traded in the S&P. And so, and I'll look at another chart of S&P positioning. It's definitely come back a good bit. So S&P positioning to me, it's not some big extreme read either way. It's not, the crowded net long it was in January. And then also, it's not some contract where everybody's pessimistic on it, like down here. And in fact, what I'll do is I'll turn immediately to some of these graphs. So these graphs are different in that they show like dollar positioning, which might be more intuitive for some people. All it's doing is taking that net contract number, multiplying it by the front month price, and then the contract multiplier to get positioning in dollars. So for example, this is how traders are positioned in VIX futures. And you can see, like I said, they're not long. They're not the net long 1.5 billion they were in earlier, the early part of this year, but it's pretty rare. Like if you go back over almost the past decade and you look at, the times of when spec positioning has been either this long or more net long, it's a very small fraction of the time. And so I think this is definitely worth noting, especially if you're sort of predisposed to long VIX exposure now. You should know that you are very much not alone in that trade. All right, some other graphs. So this is also VIX futures. It's a different way to slice the data though. So this is, in dollars, and this is as a percentage of the open interest. And then actually that graph is, I think this graph is actually old. I need to update that one. This one's same thing as that first VIX one, but for the E-mini S&P. And so we can see that traders are net long basically 50 billion of S&P futures, which is at the 2018 lows. 2018 was a weird year, and that we started out with this like crazy consensus bullish positioning in equity futures. Obviously fell back. In fact, we're at less than half of sort of where we started the year. So we hit about net long 120 billion. Now we're net long 50, and it's a catch-22 between. It's a quick reduction. But this is a very quick pullback in spec position from 120 to 50 or so. But if you look back over the life of the contract, I definitely wouldn't define, net long spec positioning of 50 billion as low. It's gotten much lower. In early 2016, it actually got to net short, which was owned. Now this is just looking at the S&P E-mini contract, but that spec positioning in early 2016 was even more bearish than it was in 2008. So to me, it's a huge red flag, or maybe green light, depends on how you want to look at it. If spec positioning in the ES gets negative again, I would definitely alert people to that. Here's WTI, and so WTI spec positioning has definitely come back a lot. We're at like net long 23 billion, which is really close to where we bottomed out in late 2016, early 2017, and the way I interpret this is that it's sort of like the E-mini S&P. It's a quick reduction, but if somebody comes to you and says, "Yeah, there's still a lot of long money tied up in WTI," there's still some, but it's just not the trade it was. It's not the crowded trade it was. That was sort of a big component of the short WTI thesis, a year ago. And so to me, positioning is sort of a wash in WTI. And then I think I've got gold. Yeah, I got gold next. So gold is sort of interesting. I talked about it on the dashboard chart, and that traders have gotten more net long gold. Spec position went from negatives, as in they were net short, to I think they're net long like 7 billion right now, which is not a big number historically, but they've just gotten more optimistic on gold. And then we can also turn to seasonality. So this is sort of the other free website, commodity seasonality. Same setup, you got individual graphs for individual commodity seasonalities, and then you got the dashboard graph that sort of aggregates everything together. So let's look at December seasonality. Not much to write home about other than December's historically been very strong for both palladium and cotton, historically quite weak for OJ. And I think if we zoom in on palladium seasonality, definitely started out the month, strong. And palladium is one of the strange precious metals in that it actually does have, really positive, December seasonality. The other stuff like, platinum, silver, gold, it's not the case. But that being said, all those precious metals are dominated when you look at their seasonal trends by like Q1 positive seasonality. So, January, February strength. And this sort of happened this year in all these metals contracts, but they faded. So for example, platinum, it ripped up like, what is that, 6, 7, 8% in January, then it just fell apart. And so in January, February, I would probably be cognizant of precious metal seasonality. But we can dive into some other seasonalities too, like let's look at financials. So in the 30-year bond, main seasonal trend, late summer strength. I mean, sort of happened this year, but it just sort of petered off after September or so. Obviously, the bonds, they've caught a bid recently, but from like a trend following perspective, momentum as assessed by like 12-month momentum, it's still really negative for the 30-year bond. So like long-term trend followers are definitely still biased to the short side. Then we can look at S&P seasonal. So S&P seasonality is, some people call it, best 6 months of the year. That's typically defined as like, start of November 1 to end of April 30. We're definitely in that period, but like I always say with seasonality takes like a massive backseat to more dominant things, be it fundamentals, technicals, sentiment. So it's always sort of like this marginal, thing on the side. Going back to the dashboard page, let me just look at January seasonality. Yeah, it's sort of the same stuff. So like metals, platinum, silver, palladium, gold, the four highest performing contracts in January historically over the past 20 years. But then January has historically been a really weak month of the year for natural gas, euro, rice, a little bit WTI. We can look at, now this is when I talked about 12-month momentum on the like on the bond right here. This metric is basically all aggregated right here, like the most recent reading. So this is just looking at like, best and worst performers in commodity futures over the past year. To nobody's surprise, front month nat gas, best performing. Worst performing though it's actually been lumber, which has been this huge round trip. Sort of like cocoa actually. Started off the year, massive ripper. It was up like 50, 60%. It's given it all back and then some. And things have also changed in the curve too. So like during most of that rally, lumber was in backwardation, meaning that like longs didn't really bleed to maintain long exposure because there was like a positive roll yield. Not really the case now. It's in contango, just like sugar. And so, yeah, so that's sort of a brief overview of seasonality, which is rest of the month. Best performers over the past 20 years have typically been palladium and cotton. Remember, January, February, precious metal strength. And then positioning wise, I would say, S&P positioning is moderated. VIX less so, positioning is more notable in VIX futures, and that traders are just more net long. And so that is it's a brief overview of positioning. If anybody's got any questions, I'm happy to help out.
I'm back over here, Adam. Great information. We are getting a question once again on the energy sector. I guess if you can go back to crude oil, I guess taking it through, based on where we are, we're basically at the lows of the year, well into last year's kind of levels. What does the positioning look like, and what's your thoughts on what it would take to become extremely, negative, net negative?
Yeah. So that's sort of an interesting thing in that, like, this graph shows even at like the super bearish lows for WTI in late 2015, early 2016, traders actually never got net short. The lowest positioning got was like a net long of like 9 billion. And so to get from where we are to there, net spec positioning would need to fall from like net long 22 billion to net long 9 billion. So that's a drop of, roughly 13, which we quickly did even more so than that recently. But yeah, to get from here to there, it would take extremely weak price action. And I would say I think of extreme positioning as sort of like a pendulum shift, in that when you get to really extreme positioning, be it, here, here, there's just, once that ball starts to move, there's a lot of momentum behind it, just because there's more people on one side of the boat, right? It's more people rushing for the exits. When positioning gets sort of moderated like it is now, it says to me that, positioning will play less of a factor just because there's less money tied up in it. And so it would be interesting to see that, we haven't really gone net negative in WTI positioning. To do that, WTI wouldn't need to fall, 5-10%. It would need to either break 2016 lows. Like it would require a massive move. But all that to say, the time to pay attention to WTI positioning or any like contract is here. It's at these true extremes, which is like the purpose of that website, right? WTI positioning right now, it's not extreme. So to me, it's sort of like it takes a backseat to other sort of frameworks to assessing WTI.
What about the pound? Brexit,
Yeah.
We're actually trading at the low of the year right here. We're trading just above 125. Actually, just jumped about 15 pips, but we're trading just above 125 at the low of the year. What's the pound looking like?
Nothing to write home about in terms of traders are basically right in the smack dab middle of their 5-year positioning. So now this is interesting to me now that you bring it up, in that, so if you look at pounds price action, you'd probably expect spec positioning to be more net short, but it's just not. So that says to me that when you have something going down in price and traders not really getting more pessimistic, they're fighting it. They're not really going with the trend. So it's sort of more of a mean reversion thing. And this leads to an interesting setup. I've seen it a couple times of where you've got a contract that sort of steadily drips one way, traders fade it, and then there's this massive sort of like positioning capitulation of, people sort of flip, quickly. And yeah, so that's interesting to me, in that pound positioning and price action are not running in tandem right now. You can see, like, recently, since what date is that? Like late September, traders have gotten more bullish on the pound as it's depreciated against the USD. And so what this says to me is, let's say the pound, fell further, you've got more people in that trade position for the exact wrong thing. And so you could sort of flag pound positioning as vulnerable, in that people really have been caught off sides with the recent moves.
What about the fact that in FX, primarily, the large majority of trading is not done via exchange; it's done other in cash markets. How do you take that into account when you're looking at all the FX currencies that you look at?
Yeah. The main way I think about it is that, like, knowing that commodities are listed futures are sort of like the home market for commodities. I personally pay more attention to COT positioning for commodities, just because it's sort of like a larger sample size of, positioning. When it comes to the financial stuff, like be it bonds, currency, stocks, yeah, I sort of assign less weight to COT data for that, just because you're only seeing one slice of it, and you're not seeing, like you talked about, non-futures positioning. And to add to that, there's a reason why, like, in most of these webinars, I never really talk about bond COT positioning. In fact, I don't even have it pulled up right now, because so in bond positioning, not only do you run into that same problem of, like, COT doesn't cover cash bond positioning, but it's sort of doubly confusing in that, as we all know, bonds are frequently spread. You could be gunning for a steepen or flatten or whatever. And the issue is, if you're looking at, like, just 10-year positioning, you're just looking at one leg of that trade. And it can sort of deceive you into the true positioning of traders. And so takeaway for COT is, I pay most attention to it for commodities, little less so for stocks and FX, and even less so for bonds.
Interesting. So I've been asking a lot of people this that come on our site as we're approaching year ends here. You speak to a lot of different traders. You speak to a lot of different people in the market. What are you hearing, and personally, and then also, what are you hearing as interesting opportunities as we approach 2019?
Hmm. Let me think. I think that this is sort of anecdotal, but I think that a lot of people have gotten too trigger happy with long bonds, as in, it's paid recently, and there's still a large amount of traders that are in the long bond trade for really, really long term reasons. Be it, they typically say, demographics are destiny, and that basically we're going to have lower inflation, maybe even deflation, and due to the way our demographics are structured, there's just no hope for, long treasury bonds yielding 5-6%. And so it's sort of like a lower rates for longer thesis, right? And to me, those people have been emboldened by recent moves. And even though the 30-year bond is still, deeply negative total return year to date. So what I'm getting at is, in my mind, sort of the short-term debt dynamics, which is, you're going to have a ballooning deficit, and you're like, so basically the short-term setup for bonds, in my mind, completely swamps this longer-term thesis of, just own long bonds and just, like, roll it. I don't. So that's sort of one thing to me is, and in plain English, what that means for personally is, like, I don't like duration, period. When it comes to, I guess, like, FX stuff, when a lot of people talk about international equities being cheap, half of it is the stock. Like, the stocks are selling at, low multiples. The other half of it is the currency. And so when you look at the currency being cheap, there's lots of ways to, like, assess currency valuation. But if you want to look at, like, purchasing power parity, stuff like that, all these foreign currencies are cheap against the USD. And the one that stands out more than the others is honestly the yen. And so to me, I wouldn't be surprised if, let's say, international stocks outperformed US stocks in 2019. That doesn't have to be because, like, multiple sort of re-rate higher international. It could solely be due to a like an FX tailwind of like, let's say you own Japanese stocks, but the currency you own them in, the yen, sort of rises against the USD by 5%, and so that's sort of an extra, I don't know, positive in the favor of international stock exposure as the currency part. Another thing that I think has tripped traders up is that this isn't so much a trading thing. It's like basically a lot of U.S. people, U.S. investors have looked at foreign bonds over the past couple of years and been like, why would anybody in their right mind own, German government debt at like, basically a 0% interest rate? The crazy ironic thing is that developed market government debt, like be it German bonds, Japanese government bonds, they've outperformed treasuries on a currency hedge basis because of the fact that basically U.S. short-term rates are high and their rates are low. And so if you're, shorting the euro against the dollar, there's sort of like a positive carry part of it. And so the positive carry part of it added to like the nominal bond yield has translated to, I remember 2-3 years ago, people were talking about, German government bonds are the perfect short, or, JGBs are the perfect short. And the complete opposite has happened. They've outperformed treasuries. And it's because of sort of this positive carry tailwind from the currency part. Let me think what else. Let me think of other things that are interesting. Let me browse through some stuff on this dashboard. Nothing really interesting on the seasonal part. I would say this. Okay. So within bonds, one thing that's been interesting lately is that break evens have come pretty sharply lower. So it's sort of like, the difference between like a nominal 5-year treasury and like an inflation linked. And so here's the thing. So, and I'll just, actually I won't pull it up, but when you're evaluating whether to buy regular treasuries or tips, a big sort of part of that decision-making process is what's the break-even difference? So let's think about this. If you buy, like right now, break-evens are like 1.7% over the next 5 years. So if you buy tips and let's say inflation ends up being much higher than that, like, 3% on average over the next 5 years, tips will outperform regular treasuries. But vice versa, let's say we have this, deflationary collapse, nominal treasuries will outperform. What I'm getting at is that break-even sort of like, to me, are sort of the fulcrum to where I assess whether I want to lean nominal or tips. So if break-evens are super high, that means that the market is sort of anticipating higher inflation, right? And so in that environment, tips are sort of expensive because inflation sort of has to be high for them to be a better bet relative to nominal treasuries. That's not the case now. Break-evens are lower. So when break-evens are lower, it's like inflation, like you could have inflation of 2% per year over the next 5 years, and tips will outperform nominal treasuries. And so to me, if you're looking at like bond exposure, tips have become more attractive as break evens have come down. It sort of lowers that hurdle required inflation for tips to be better. And so I know all that stuff is a little bit more longer term than like trading stuff, but I guess those are some things that I think.
Interesting. Yeah, a lot of interesting themes. I've been asking, and I'm going to continue to ask every person that we have on, just to give people an idea of what to be looking for, what might be changing, and what to be out and look for as we approach the new year. Right now, we're going to take a look and a listen, but it sounds like Nancy Pelosi, Chuck Schumer, President Trump, and Vice President Pence were just in a bit of a exchange on TV. I'm looking forward to hearing more details about it, but I think it has to do with building the wall and the shutdown or the deadline coming up in a few weeks. But that'll be pretty interesting to see.
Yeah.
But as always, Adam Collins, a lot of great information. I really appreciate it. You can catch Adam's stuff. He's got a bunch of different websites: movingcapital.com, freecotdata.com, marketseasonality.com, and final one?
SimpleStockModel.com.
Stockmodels.com. All right, we'll talk to you next week.
All right, thanks so much. Bye.